Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Happy New Year's. Today, we have a great returning guest. We're joined by Cullen Roche, founder and CIO at Discipline Funds, a financial planning firm that focuses on holistic advice and has 3 defined duration ETFs. Big news, his latest book is out, Your Perfect Portfolio, the ultimate guide to using the world's most powerful investing strategies. Cullen, welcome back to the show.
Meb, what's up? It's great to be back.
Congrats on the book, man. You just figured you got young kids in diapers. Good time to do it. Was that the inspiration? What was they're growing up now? What's the story?
Yeah. No, I figured that if I launched a whole bunch of ETFs this year and wrote a book, that was going to be my excuse to get away from the kids full time. So no, weirdly, it's the opposite. I feel like the kids lit a fire under my butt where I felt like I had to start thinking about, how am I going to pay for these little munchkins? And so in the last few years, I've actually started to get re-energized about a lot of stuff.
The book is really fun. It's a mix of personal. So there's some Chuck Norris references. There's references to a young, rascally Michael Covell, another podcast alum. There's some references to a lot of the portfolios, which we're going to spend the meat of this conversation talking about. But also, I thought it was interesting in the beginning, you talk a little bit about principles for portfolio construction. You had an interesting choice in the title, which use your perfect portfolio, not the perfect portfolio. Intentional? Tell us what you meant by picking that specific title.
I think that a lot of people go into portfolio construction in search of the perfect portfolio, and they think of this from the perspective of really, I think, the way that people oftentimes sell a strategy to them, that there's this idea that there's some sort of like holy grail out there, that a strategy that will serve everybody well. And I think people oftentimes bounce around from strategy to strategy thinking they're going to land on that one portfolio that, is consistent with some famous macroeconomic guy or some famous investor, and they're going to then adopt this portfolio and be able to stick with it. And over the course of my career, I've just sort of realized that I've worked with so many thousands of different investors over the course of my career that in retrospect, I think virtually none of their portfolios have ended up being exactly the same. And that's in large part because we're all just different people. We have different goals, we have different needs, we have different time horizons. And so everyone's portfolio is a little bit different. And I wrote the book I tried to be very objectively unbiased in the way I approached it. And I write about the pros and the cons of each of the 20 main strategies that I talk about, with the purpose of being sort of an objective, independent analyst. And the goal behind all of that is to help the reader decipher what is good and what is bad about this portfolio, and how could I maybe apply this to my life? Because that's the other thing, is that there isn't a perfect portfolio inside of the book. A lot of it is structured in a way where the commentary is designed to be utilized so that someone can, maybe in your IRA, you're a young investor who wants to be very aggressive. You got a very long time horizon, and maybe the 100% stock portfolio works for you. There's a portfolio called the forward cap portfolio, which is very aggressive, very long-term thinking. Maybe that's your perfect portfolio in an IRA account, whereas you're managing something that's a much more short-term account. There's a chapter called the T-bill and chill chapter, where maybe that portfolio is totally different. So you can kind of pick and choose, and you can build a portfolio that's right for you and is serving your financial goals and needs based on the way all these different portfolios kind of function.
Yeah. And we'll come back to the portfolios a little bit later in the discussion. One of the interesting takeaways, though, listeners, is I think a lot about this, where people with seemingly similar objectives, ideas, even conclusions about how markets work, about assets, it's like almost like chaos theory. You start to make these little decisions as you go down the decision tree, and you end up with a vastly different portfolio. So Cullen may have 4 funds in his portfolio, and I may have 20. It may be a mixture of ETFs. His may be a mixture of funds and stocks and all private stuff, on and on. And it's kind of a crazy just how different, these little decisions we all make. So what I wanted to talk about, because the cool part about a lot of the chapters are there's some history intertwined and some storytelling about some of these strategies. But I want to start first with, you talk about 10 principles for portfolio construction, and I'm not going to read all 10 of them, but I will talk about a few what I consider to be somewhat outliers that are fun to talk about. And number one is one of my favorites, where you say, you are a saver, not an investor. And I'm gonna read one of your quotes where it says, your investment portfolio should more appropriately be thought of as a savings portfolio. What do you mean by that?
What's weird, this is actually kind of a rollover from my first book. When I wrote Pragmatic Capitalism, I had this struggle where I was writing a book that was really both about macroeconomics and about investing. And the weird thing is that in the field of economics, the word investment has a totally different meaning than it does in the field of finance. And in the macroeconomic world, the term investment means to spend for future production. And that's done by firms. And firms will, interestingly, they fund a lot of investment by issuing shares of stock. And so, you might sell stock or, issue bonds or something like that to fund investment spending so that the firm can go out and, generate a return on investment in the long run. And hopefully the value of that is reflected in the share value, and they repay interest on the bonds through income based on their investment spending. And the interesting thing, though, is that the people who buy those securities on the secondary market are not necessarily funding investment in any real way. What they're actually doing is they're buying an instrument that reflects the value of savings. The investment spending from the firm actually generates the value that accrues to the shares. And so it's interesting thinking about this perspective, because the word investing is not really what someone does when they're buying shares of, XYZ stock on a secondary market. They are quite literally, they're reallocating some of their savings into an instrument that will reflect the value of the firm's investing. And the reason I like this concept is because I think a lot of people get into the world of investing and they think of it as sort of a get rich quick sort of endeavor, where this is something that it's sort of sexy. They're going to generate super high returns. They're going to make a lot of money really fast. And the idea of allocating your savings is totally different. It's generally thought of as being very boring and very prudent. And I think that this is the right approach, though, for the vast majority of people, that they should think of their portfolio more like they're allocating their savings than getting into some sort of get rich quick endeavor, which is oftentimes what I think trips people up when they jump into an investment portfolio and they think, oh, this is almost more akin to gambling. And the weird thing is, the connection to gambling there is that when you buy a ticket at let's say a horse race or something, you actually have no impact on the horses. And that's really when you buy shares of stock, you have virtually no impact at all on the actual outcome of what the shares do. You really are buying something that is a function of what the way the firm is spending for investment, in much the same manner that when you buy a ticket at a horse race, you're buying something that's issued on sort of a secondary market. And I think that people sometimes think that they're doing something, though, that has this very sort of direct impact on the way the firm is going to operate or be able to generate returns in the long run. And the reality is that what they're doing has no impact or very little impact on it. And prudently allocating all of this is sensible because it's more consistent with the idea of doing something that is consistent with savings rather than a sort of get rich quick scheme.
You hit on a couple topics in there that are super deep and interesting. We just cannonballed into the pool right out of the gate. The first part, I can't remember if this was the Rick Reader or the Anti podcast, but we were talking about sort of the philosophy and how people approach fixed income is different than equities, meaning the reason why people often behave so much better in bonds is they think in terms of yield.
Yeah.
If bonds go down, hey, guess what? They got higher yield. Stocks is the exact opposite. Like no one ever is like, oh, great, stocks are down 50, my yield's way up, right? Like they're like, all my money's gone. So it's like a little of emotional framing issue there. I think people behave a lot differently. Anytime you start to put target date funds, retirement accounts, IRAs, all-in-one funds, which we both manage, all these type of ideas, people tend to behave more than in their hot investing Robinhood account, a gambling, speculating account. It's like a totally different mindset. And I think the former probably wins in 99 times out of 100.
Another aspect of this is that when you talk about savings, I think you necessarily start talking about time horizons too, because when you're allocating savings, you're generally doing so for a specific purpose or specific goal in the future. And so you might be, maybe I'm putting away $100,000 because I want to buy a house at some point in the future. And you're saving for a very specific goal. I'm saving for retirement. When we talk about savings, you generally are aligning it to a time horizon based goal. And, I loved the podcast with Antio because he talked about the mathematical difference in the way that people think about stocks and bonds. And I think a lot of that has to do with this time horizon factor where the function of a bond's returns is based in large part on time horizons. And you know the relationships between the way that like a bond's duration interacts with its interest rate risk. And, a bond's returns will reflect certain risks across very specific time horizons. And so I think that understanding the time horizon is so useful inside of that because the investor then can look at an environment where you say that, oh, I owned a 10-year treasury bond and the Fed just raised interest rates, 2%, and that thing fell 20%. And here we are 2 years later or 3 years later or whatever. And this thing now is a 7-year instrument that has fallen, 20%, but is yielding 2% more over a shorter time horizon. It is mathematically, its risk-adjusted return has essentially improved over the time horizon over which you're judging it and you're quantifying it. And so you can think of these instruments inside of these very rigorous sort of mathematical concepts inside of fixed income oftentimes, which is what it makes bond investing so much more appealing to a lot of people, especially people who are building things like tips ladders or bond ladders of any type, because you can quantify this and build out, like a liability driven portfolio in this very mathematical way where you don't have absolute certainty of the outcomes, but you have a very, very high understanding of what the probabilistic outcomes are going to be. Whereas the stock market is this sort of totally unknown because it doesn't have the same temporal relationship.
This is another one of yours. You're talking about asset allocation is a temporal conundrum. What does that mean?
Well, so I write about how all financial planning and all asset allocation ultimately comes down to time horizons. We're all trying to navigate the finite period that we have on Earth here, and we're trying to manage our assets to match certain expenditures across time horizons. And, the goal for all asset allocation is basically to hopefully make as much money as you can to fund all of those needs, which mathematically is also not the way that the financial markets work. The stock market is typically a long-term instrument because the underlying firms are typically generating revenues and income over very, very long periods of time. The average, institution inside the S&P 500 is, like 20 years old at this point, I think. And these are old entities. That stocks are companies that have been, the stocks that we know of are companies that have been around for a fairly long time. And so it's not a get rich quick endeavor. Whereas, something like a 1-year T-bill is it's a totally different animal. And when I say that asset allocation is a temporal conundrum, you're balancing the time horizons of the way different outcomes will play out across different instruments. And I often talk about in the book about how the real benefit of diversification is not just that you're diversifying across assets in a lot of cases, you're diversifying very specifically across instruments that have different time horizons. I mean, when you buy something like a 60-40 stock bond portfolio, you're not just buying something that it is comprised of different instruments. You're buying something very specifically that is comprised of different instruments that have different specific time horizons, where the 60% piece is generally this longer term component, whereas the 40 piece is actually comprised of, inside of itself, it's a mix of all sorts of different time horizons, from, overnight repos to potentially 30-year T-bonds inside of these things. So I talk about how all of this is really, in the end, we're trying to solve the problem of time inside of asset allocation, because we're all trying to navigate the uncertainty of our future consumption, as Ken French says, over these very uncertain time horizons.
The classic example is simply the yearly returns of stocks. And then if you start to say, then 5-year rolling, 10-year rolling, 20-year rolling, and you watch this distribution just slowly shrink. And there's a fun stat, we'll put it in the show notes, may have seen it in your book, but there's a kink, which it's some yearly level, the rolling returns of stocks and bonds, essentially condensed to about the same number. I think it's 20 years. But it's pretty cool, because if you look at stocks on 1 year, you'd say, oh my God, stocks are so much more volatile than bonds. But as you kind of roll that out to 20 plus years, all of a sudden the volatility becomes almost equalized. You made one really interesting choice in this book that I love, but I would say is non-traditional. And it's one of the 10 principles. You guys will have to go read the book to get the rest of the principles. But one of them is you speak in terms of real returns. And we've often said that, real returns are the only thing that matters. It's the only thing you can eat when it comes to the end of the day. But it's not the normal vernacular of media. Maybe it's the vernacular of academics, but day to day, CNBC, Bloomie, no one really talks in real returns. Talk to us about the decision and why it matters.
Yeah, so this one, I very intentionally wrote all of the analysis. So there's a lot of data, a lot of, back testing and returns of each portfolio. And all the data I presented was done in an inflation adjusted basis. And the main reason I did that was because, this is kind of interplays with the whole you're a saver concept, but also the idea that real returns are what you actually eat, and also interplays with essential principle number 10, which is setting realistic expectations. And I think that a lot of people, they hear sort of fantastic numbers in the media, like the stock market does 10% per year. And that number sounds high. It sounds, like something that maybe actually in the long run might make you rich. You start running the numbers on this stuff and you start thinking, if I could beat 10%, maybe I do 12 or 15% per year. Well, after 5-10 years, maybe I won't have to work this crappy job or something like that. And I think the problem there is that the average investor doesn't come close to generating anything close to the actual 10%, because once you back out, there's inflation, which is a big one, so lop off 3% a year. The average investor is probably paying, 0.5% to maybe even 1% per year in either fund fees or advisory fees. And then you lop off the other real biggie, which is taxes. And taxes are the ones that a lot of people don't quantify, that really will slaughter you in the long run, because that one's going to end up being, 20, 30, 40% of your gains in the long run even. And so once you back out all of this stuff, your return, the amount of money you're actually putting in your pocket ends up being not a meager number, but on an inflation adjusted basis, it ends up being a lot smaller than that 10% headline that we oftentimes hear about. And so I tried to present this in terms of something closer to, hey, this is the amount of money that you're actually going to be putting in your pocket rather than, the amount of money that is sort of a paper gain that is a number in the media that sounds really appealing, but in real life, in terms of our ability to actually consume goods and services in the future, is really like an irrelevant number.
I think this is most stark when you think about a couple things. One, it is a little easy and lazy to speak in nominal terms, but if you talk to someone where there's been, for example, hyperinflation, it totally invalidates any discussion you could possibly have about talking in nominal returns. And the second one, of course, being is that some asset class, the risks are masked. Bonds are the classic example. We love doing our polls, and one of the most famous in my memory is saying, what's the sort of drawdown of T-bills or bonds? And people are always, and like after inflation in the past century, and everyone's like 0, 5%, maybe 10, and it's over half. And so that's a pretty wide, Grand Canyon wide spread in understanding, right? People think that you have these assets that are totally immune from volatility and loss, when in reality, it's just a different risk, which is that of inflation, which is meaningful, particularly over long periods.
Yeah, I mean, arguably the biggest risk to our portfolios in a lot of ways. And that's another thing I talk about in the book, is that the different instruments will serve very different needs across different time horizons. Like, T-bills or cash, I'd argue you don't really allocate to T-bills to try to generate a real return. You're investing in cash primarily because you just want principal certainty. You want to know, hey, I've got, $100 today. I want to know that I've got $100 tomorrow. And I don't necessarily care about the rate of inflation. But then, if you're buying things like, you look at a portfolio like, I talk about the permanent portfolio in chapter 9, and that portfolio is very robust to inflation because it's designed in a very specific way, where Harry Brown, who was the guy who created it, Ray Dalio, he comes into the investment world in the 70s, basically, in this world that was just incredibly traumatizing, and the political risks were crazy, and there were weird things going on geopolitically with like the Vietnam War. And then you've got the Nixon shock when, Nixon takes us off the gold standard fully. And then you've got the huge inflation of the 1970s, which you can only imagine, like people are traumatized by the inflation of the recent years here from the sort of post-COVID period. Imagine that, but imagine it just persisting for basically 10 years. I mean, that's what the 1970s was. And so these are hugely formative environments that these famous investors were sort of, building their strategies in. And the permanent portfolio is something, though, that it's very robust to inflation because of the way it's structurally designed. But at the same time, it's also designed to be an all-weather portfolio. And Harry Brown constructed it very specifically so that it's serving all of these different needs. And he built this with, these 4 different quadrants, where he had a cash component, which was supposed to be the sort of the recession-proof component. That's just giving you certainty. The T-bond component was supposed to be your deflation component. The stock market is supposed to be your sort of growth component. And then there's the gold component, this is like your high inflation hedge, basically. And when you put all this together, you're kind of covering all of these different bases in a very sensible way. And it's the Harry Brown permanent portfolios, in a lot of ways, it's kind of like it's one of the more interesting portfolios in the book, because it's very, very simple, but it's also an incredibly thoughtful and diverse portfolio that it's held up like unbelievably well over the course of the last 60 years since he created it.
Yeah. Well, one of the things that I feel like is the biggest disconnect when you talk about academics, and while we're here talking about this idea of inflation, almost always when you talk to the academics, they always talk about tips. They just love including tips in a giant part of the portfolio, as opposed to most practitioners, it's not as much. I always scratch my head when I see that. You go talk to some academic and they're like 50% in tips, or whatever it is, and you're like, I don't know many practitioners that do that, but it's an interesting, again, going back to the very beginning of our discussion on portfolios, philosophical difference that ends up in a totally different place.
Yeah, I have that debate a ton with different people because I do a lot of sort of duration matching in my own practice and whatnot. And my own philosophy now is kind of based around trying to build what I call basically like asset ladders, which is basically using like multi-asset portfolios and embedding stocks into like bond ladders basically, or bond ladder like portfolios where you can give people greater certainty of time horizons. But yeah, I had this debate with people about tips. It's one subject in the book that I sort of waffle about. I don't really express like a strong opinion about tips. Is interesting because like Bill Bernstein, he's featured in one chapter. I did a great interview with Bill, and he is a huge fan of tips ladders. The endowment portfolio talks about tips a little bit because Swenson was kind of a big fan of tips to some degree. And, I struggle with it personally. I struggle with it in a time horizon based perspective because I'm a believer that long-term bonds I just think they're terrible long duration instruments, basically. That's like my general view. I think if you have a time horizon of 7 years or more, basically, I would say you're better off go buy a 60-40 portfolio if you want something that's, modestly boring, or go buy, God, if you've got a longer time horizon than that, go buy stocks, buy anything that's got, but I feel like almost anything over that sort of a time horizon will generate better risk adjusted returns than something like a T-bond, especially and part of this is probably that I have kind of going back to my macroeconomic background, I have a little bit of I guess, apprehension with the way that the bond market is structured anyways, because like when I look at like an aggregate bond fund, I'm always confused as to why anybody would buy something like this, because the aggregate bond fund is basically an instrument that it just eats basically whatever the US government force feeds it. I mean, that's really what this thing is turning into at this point. It's not when people buy like a market cap weighted stock fund, they're buying something that is a totally different animal than what we call the market portfolio for bonds in an aggregate, because the market cap weighted stock portfolio is something that it destroys itself over time. It is competing. The entities inside of it are destroying one another. They're evolving. They're changing. The bad firms get thrown out. The good firms get pulled in. And there's competition there that's market driven. Whereas with a bond aggregate, that index is basically something that it is literally just taking whatever is issued. And who's the main issuer of bonds in the US economy and the global economy, frankly? It's the US government. And the US government does not care what interest rate you want or whether you're concerned about duration risk or anything like that. They're funding their liabilities at whatever they want to. And the Federal Reserve is coming in and buying a lot of these bonds at interest rates that may or may not be favorable to other investors. So, I really struggle with the concept of buying longer maturity, long duration bonds, because I just think that on a risk adjusted basis, the probability of you generating better returns in other instruments is just, once you've got the luxury of thinking in 7, 10, 20-year time horizons, the probability of being able to generate better returns in other instruments is super high. So I struggle with anyone that builds like long-term tips ladders and whatnot.
Don't feed at the U.S. government bond trough, maybe is what Cullen's trying to say. Whatever they force feed you out in the buffet.
That's not to say government bonds are really, really useful for, like, I am a huge advocate of like the whole T-bill and chill portfolio. I'd say like I basically chew out all types of like CDs and high yield savings accounts, things like that, they're very suboptimal when compared to things like a T-bill portfolio that can be very simply managed. Our buddy Wes Gray runs the Box ETF, which is, one of the probably most brilliant creations of the last 20 years in the ETF world, but that's a synthetic T-bill portfolio. So these, T-bills and some government issued notes are extremely useful. And that's one thing. I try not to be militant about anything. I sound a little militant against long-term government bonds, but I think government bonds have their place in a portfolio too, where, I would argue that if you're building a bond ladder, anything in the 0 to 5 year range is going to result in probably a really beautifully systematic and certain outcome. If you're building that even if it's a mix of, say, T-bills and TIPS, you can structure that in a really beautiful way where you're building something thoughtful that doesn't expose you to a lot of the long-term risks that might be associated with something like a 30-year treasury bond.
So you mentioned 60/40. I feel like this is always the starting point for almost any institution. Talk to us a little bit about, I like in the book, you talk a little bit about history. Where'd that come from? Did someone just magically one day come up with 60/40? Why isn't it 50/50?
It's
70/30,
so weird, isn't
20/80?
it? So this is arguably the most famous portfolio in the world. I would say that the vast majority of investors probably end up with a portfolio at some point in their life that looks a hell of a lot like a 60/40 to some degree. And it was interesting. Who got me going on this was actually Corey Hofstein. He was writing on Twitter one day about this, and he said, where did this come from? And there wasn't a single good response to his tweet about this. And then I started doing research on this. It just so happened to be during the writing of my book, and I'm writing this chapter on 60/40. And I realized that I gave no background on why is this thing a thing? And which is such an interesting concept to think about, because the most famous portfolio in the world doesn't seem to have an origin story. It doesn't seem to have a founder. Like so many of the portfolios that I write about, they are associated with a person or an event or something like that. And I kind of pieced it together, I think, to some degree, or at least I put together a little bit of a storyline with it, where I basically concluded that the 60/40 portfolio came from the Great Depression and was really the creation of a mutual fund called the Wellington Fund, which a lot of people probably recognize because the Wellington, Vanguard, and all that. But interestingly, was run by a man named Walter Morgan, who had been burned before the Great Depression and built sort of a balanced portfolio that was very bond heavy, because he didn't want to go through something that would include a big stock downturn. And this portfolio that he built with the Wellington Fund, it went down a lot during the Great Depression. He actually created it almost right before the Great Depression, so he had horrific launch timing on it, but it performed well on a relative basis. And this is around the same time where a lot of investment advisors and institutional managers are starting to actually keep track records. And they noticed that, hey, this Wellington Fund, it got hammered during the Depression too, but it only went down, say, 40%, while everything else was down 80%. That's amazing. How did he do it? What is this thing? And so Walter Morgan kind of makes this portfolio famous because of its outsized relative performance. But then it goes through a series of transformations over time, where over the course of the next 40 years, it survives over this very traumatic period. It goes through World War II, and then it goes through the 1970s. Interestingly, a guy named John Bogle gets hired by Walter Morgan to then run the Wellington Fund. And Bogle, weirdly, actually turns the fund into a very aggressive sort of like 70/30 or 75/25 fund coming out of the 1960s, sort of chasing performance. And the fund struggles through the 1970s because the 70s were a pretty traumatic period for stocks and bonds. But the fund comes out of the 70s and then has a 40-year run that is like unheard of. We all know that 60/40 is kind of like the gold standard now. And so this fund has been through a lot of sort of like trials and tribulations, but it has stood the test of time. And it all sort of began with the Great Depression and Walter Morgan feeling like he didn't want to go through getting burned by the stock market. And so he creates this balanced index that it hasn't always been exactly a 60/40, but it has on average looked a lot like a 60%, 40% bond portfolio. and has been a very balanced and reliable portfolio throughout history.
Yeah, one of the cool things about your book is I think it removes a little bit of the judginess that everyone seems to have about asset allocation. I think so many people, particularly when they're younger, they want to tell you this is the right allocation, this is what you should do. And many advisors, part of their value add is they're often like, no, this is the way you should invest. And the older I get, the more often I'm like, look, man, bro, you want to do 60/40? Good for you. Like if you're happy with it, like go on. But my asterisk is always just at least know what that has meant historically. Like to me, that's the part where it kind of just know what you would have gone through, what you've been through, because once you go through the struggles, you need to be able to step back and say, okay, is this something I should expect, or is this totally out of left field? And 60/40, despite feeling conservative, if you look at most countries around the world, I think on a real basis, most of the 64 portfolios have just gotten absolutely whacked at
Yeah.
one point or another. In any country you pick, there's been at least one period where you probably couldn't have sat through if you in that strategy.
Well, I think that's one of the lessons too from the book is that, I talk a lot about all these portfolios most of them are relatively diverse. And, Brian Portnoy oftentimes says that good diversification is learning to hate some part of your portfolio all the time. And that's arguably the hardest part about building a portfolio is that I think a lot of people will look at their portfolio and they want the whole thing to be perfect and they expect all of it to be performing perfectly all the time. And one of the hardest things to get used to in good portfolio construction is understanding that actually when some part of your portfolio is performing poorly, it probably means that your portfolio is working the way it's supposed to be, because there's going to be times when, everything's good and the stocks are going up and the bonds look terrible for now, and the inverse will happen at times. And so I try to emphasize in the book that perfect is the enemy of the good in this process in a lot of cases, and that you're not going to find the perfect portfolio, but you find a portfolio that is good enough for you. And so I try not to be overly judgy and try to emphasize that the grass is always going to look greener. And a lot of the times when when your grass is brown, you need to just spend more time worrying about why your own grass is brown rather than, worrying about, burning it all and jumping onto somebody else's yard and thinking that you're going to then adopt that, because their yard is likely to turn brown at some point in the future. And then you're just going to be, you will have adopted that yard, and in the future, then you'll jump into a different yard. And that's a lot of what I try to avoid with the book, is that my own career has been a series of me jumping from portfolio strategy to strategy, trying different things. And I say that this has resulted in a lot of portfolio divorces that I hope the reader can kind of then experience through the book. And hopefully you don't find yourself being a 40 or 50-year-old guy that is still single, or having one night stands with portfolios. And hopefully you can kind of accelerate your process by finding a portfolio you can stick with.
The challenge that if we put numbers to this, years ago, we looked at kind of this where we said, comparing kind of the best and worst allocation portfolio in any given year, despite over time, they tend to cluster any given year. Anything can happen. Look at this year. Silver was up 100%, at least when we recorded this. Platinum, palladium. On the flip side, OJ and cocoa down a bunch. Anyway, but the point being, the allocation portfolios in any given year, best to worst, is like a 20 percentage point spread. It seems in your head, if you're stuck in one of these laggards, lagging whatever is working, like that's not just like a few months, like that could last a few years. And I feel like for a lot of people, that's really, really hard. And particularly for the last 15 years, that's mostly until this year in 2022, maybe really been a story about whatever you had to have as much SPY as possible, and anything else was a mistake. Let's hop over to, I want to talk about a couple more portfolios while we got you, and we'll let you kind of pick and choose. There's two in particular that I feel like the audience will be less familiar with. The global market portfolio, I feel like we've talked a lot about on this podcast, and you can hit on that if you want, but I really wanted to get to forward cap and defined duration. You want to tell us what those forward cap is first, maybe, or you can guide this as you see fit.
Yeah, so the forward cap portfolio was the book, just so people kind of know, it's a lot of the majority of them are just famous, well-known portfolios. The Buffett portfolio, 60-40, permanent portfolio, risk parity, trend following, things that a lot of the listeners here are going to be super familiar with. There are a few that are original, that are kind of constructs of my own, and the forward cap portfolio is one that I wanted to call this the future cap portfolio, because I thought that forward cap just sounded like, what you're wearing basically on your head right now. But there's a company in Hong Kong that has it copyrighted, so I knew I was going to run into a problem if I called it the future cap portfolio. But what the goal of this portfolio is to actually sort of skate to where the puck is going. And so the thinking is, well, the current market capitalization of something like SPY, what it's really doing is you're buying the current market cap of, the expected future returns of this instrument, basically. And the instrument isn't necessarily predicting all the way out into the future of what the market capitalization of what this instrument might look like in, say, 30 years. And so what I tried to do was try to build out 5 super sort of macro trends that would influence the way that the markets might evolve over the course of the next, say, 30 years. And I tried to sort of extrapolate out what could the market capitalization of certain sectors in the global economy look like in the future. And you build a portfolio basically that is then buying what does that forward capitalization look like. So what will the weighting of technology, for instance, be in the S&P 500 in the year 2050? And I extrapolate this big trend out. I use the sort of, the old quote from Mark Andreessen that technology is eating the world, with the idea that this is sort of macro trend, mega trend number one. And it's obviously the one that in the current environment is the most sort of in our face with the AI trend, and the one that seems the most obvious. But when you extrapolate this trend out, the way that I basically run the numbers is it ends up with a market capitalization of like 40% in 30 years, which arguably, who knows, that may be actually super low. I think the current market cap of technology inside of the S&P 500 is like 28% or something like that. I may be off by a little bit. I haven't checked it in a while. But the point is that if you're trying to skate to where the puck is going, you would actually build a market capitalization that is based on what is the market cap going to be in the future. And that way you've owned the things inside of the index that have grown the most, basically. And so this forward cap portfolio it's a portfolio that is built on these 5 sort of mega trends. And the mega trends are technology's eating the world. I write about how human beings are eating the world. That's basically the idea that consumption is going to accelerate in the future. Emerging markets are eating the world. Healthcare is eating the eaters. That's basically a play on the way that the healthcare systems are all going to get vastly more expensive. As we become greater consumers and wealthier, the emerging world is going to start looking a lot more like the developed world, which is going to bring a lot of people into, sort of upper echelon healthcare systems, and in a weird way, actually erodes the health of the actual consumers that are within that system as they become wealthier. And then the final mega trend is decentralization is eating centralization. And so we sort of see that with the rise of things like the cryptocurrency world, and the way that some of these decentralized systems are starting to eat away at the centralized systems. And so when you put all this together, though, you get a portfolio that's very, very different looking than something like the S&P 500 and the global financial asset portfolio, because it's extrapolated out into this sort of extreme, really aggressive looking sort of allocation that is attached to a necessarily very long time horizon because I'm extrapolating these trends out to 2055, basically. So we're going like 30 years out into the future and doing a lot of guesswork. A lot of people are going to say, oh, this is a super active guesswork about, what the world is going to look like. And, my answer is, yeah, it absolutely is. That's kind of the whole point, is that I'm very actively guessing, based on what I think are reasonable guesses and pretty reasonable data too, pretty reasonable long-term trends. It's weirdly kind of a corollary to like a momentum strategy or a trend following strategy, in a sense, in the sense that I'm not necessarily using rear view looking data to try to extrapolate it forward. I'm just guessing what is the trend going to be in the future, basically, are some of the trends that are in place now going to continue to work in the long run. And so it was a fun one to make because it's very, very different. It actually ends up being a weirdly, like a hugely, hugely diverse portfolio. It was really interesting to actually pick the instruments that were going to go into it because I didn't actually know what the back-tested performance would look like in it. And I kind of had like an idea because I knew what technology had done. I knew what healthcare had done. I knew what emerging markets had done. But the really interesting thing about building that portfolio was that I picked the instruments and then I back-tested them, and this ends up being a very, very diverse portfolio. It ends up being a very global portfolio, and it ends up beating the US stock market, which totally shocked me because I would have bet you $1 million that if I was picking a series of global instruments, that there was almost no chance that this would have beat a total US stock market index. And so it's riskier. So on a risk adjusted basis, it's kind of a toss up. But it was really interesting to me that this portfolio, it so handily beats the pants off of the global stock market that I was shocked. And, who knows if that's going to continue into the future. But I thought it's an interesting portfolio, and it's one that was really fun to build because it kind of brings a lot of my macroeconomic work into more of an indexing style, forward thinking sort of strategy.
All right, Cullen, next let's talk about probably one of your most unique ideas that's also implementable, because you now have 3 ETFs. Congrats. Defined duration. Talk to us about what that means.
Yeah, so I have spent my career working with a lot of retirees and people who are very worried about time horizons. And so I necessarily end up building a lot of portfolios they look like bond ladders, basically. They're very time horizon based, and they're giving people structure around the time horizons over which they're able to fund their liabilities and their consumption. And so I weirdly always run into this problem, though, with the stock market. I never know how to communicate the time horizon of the stock market. And I started thinking about this back actually around the time when my first daughter was born, because it kind of hit me in the face that I need to be more thoughtful about the time horizons over which I'm treating my own money, because this is early COVID and my daughter is, a few months old, the market crashes. And my portfolio was very aggressive. And I kind of went through that whole early COVID period thinking, holy cow, I need to like redo all of my estate planning and my portfolio construction because I've got this now different time horizon because of my daughter. And it really like messed me up in a lot of ways. It forced me to rethink portfolio construction from a totally different perspective, because that's what kids do. They basically poison your brain with lots of either good or bad ideas. And this has ended up, I think, being a relatively good idea, because I ultimately, what I did was I tried to build a model for quantifying the time horizon of different asset classes in a lot of the same way that we do with fixed income portfolios, where we're, when we try to build out a bond ladder, you're trying to build out the time horizon over which you can generate a reliable return stream. And that's the beauty of a bond ladder, is that it's very time horizon based. It gives people a very sort of tangible understanding of the way they're going to generate their returns across different time horizons. And the tricky thing with asset allocation, though, is always the stock market, because the stock market doesn't have a time horizon. It's To a lot of people, it's a perpetual instrument. We talk about it in terms of like stocks for the long run. If you turn on financial TV, you might think that the stock market is like a daily instrument or a weekly instrument. You're going to get a billion 2026 forecast this year that'll make you think that the stock market is a 1-year instrument. And it's like, well, what is this thing? What is a reasonable time horizon over which to judge the stock market? And I created this concept that I call defined duration, which tries to actually quantify a reasonable time horizon over which to judge an instrument like the stock market. It can be applied to virtually any instrument, but the stock and bond markets are where it's most quantifiable. And what I'm basically doing is I'm estimating an expected future return based on a potential max drawdown, real terms. And what we're really trying to measure is sequence of returns risk. So in financial planning and especially retirement planning, sequence of returns risk is kind of like the holy grail, giving somebody certainty of their ability to retire across time. And I'm trying to measure what is the sequence risk of a portfolio and how can someone apply that then in a way where they can actually build a portfolio that matches their desired sequence risk to certain assets. And so it ends up being basically what is like a liability driven investing portfolio is what the old institutional name for it would be. I like to call it asset liability matching just because I think it's a little easier for people to understand, but it's a concept that is very fundamentally financial planning based. And so you're able to build a financial plan for somebody, quantify specific financial goals across specific time horizons, and then you can plug and play certain instruments based on what is their defined duration. So for instance, a T-bill has a defined duration of basically 0 because it has no sequence risk really. Whereas something like a 5-year treasury note, it has a defined duration that is pretty close to what its traditional duration would be. Like if its modified duration is, let's just say 4.5 years, the defined duration will end up looking roughly like that because you're quantifying the sequence risk of the instrument. Whereas the stock market, it actually has lots of different defined durations. Like if you're running this sort of a model in the current environment and you input something like technology stocks, well, technology stocks actually inside of my model have pretty low future expected returns. And so their defined duration ends up being very long. It ends up being close to like over 30 years. Whereas something like a foreign value index probably has a defined duration that's closer to something like 15 years because its expected max drawdown relative to its expected returns is much lower. So it has lower sequence risk. And the benefit of doing this is really that I think, especially for the stock market, you're putting reasonable time horizons in perspective over which an investor can judge, especially a max sequence of return risk environment relative to their portfolio so that they can compartmentalize different instruments across different time horizons as it pertains to their financial goals. And so it allows you to not only build an asset ladder like portfolio, but it allows you to also blend different instruments. Like going back to our discussion before, I would argue that if I built a defined duration instrument that was matched to a target 10-year time horizon, you can generate reasonable real returns over 10-year time horizons that, in my view, will match much better to a 10-year time horizon compared to something like a 10-year tips ladder. Like, would I rather own a portfolio that is 40% stocks and 60% bonds? And let's just say that I'm making up an example, but let's just say that that has a 10-year defined duration when you blend the different instruments together. Will that instrument over a rolling 10-year period, will it generate a better real return than something like a 10-year tips instrument will or a 10-year T-note? I think so. And so you can build multi-asset instruments inside of this model where you then are not only giving very front-loaded certainty inside of, say, a T-bill ladder or a 0 to 5 year bond ladder type of instrument, but then also blending in different types of other longer term instruments where you're, from a financial planning perspective, you're giving somebody certainty of consumption over very short time horizons, but you're also compartmentalizing the most behaviorally difficult instruments, typically the stock market or longer term instruments, inside of compartments where you are sort of siloing their behavioral risk in a lot of ways. Because I think that the stock market especially is something that in the short term generates a huge amount of behavioral uncertainty for well-known reasons. And it's hard to judge the time horizon over which to actually have reasonable expectations of that instrument. And when you block these things out, if you're building a defined duration-based portfolio where, for instance, the long-term asset allocation is in stocks, what happens here is that when the stock market goes down a lot, you kind of look at it and you've compartmentalized it where you can say, okay, well, the stock market is down a lot this year, but I've got these other buckets that are aligned to my financial plan that are funding my needs for, say, the next 0 to 5 years. I don't care what the stock market is doing inside of that period, because I know that the stock market is a 15+ year instrument, for instance, and I can only judge that instrument over a 15+ year period. And I think that, it's kind of the other thing you talk a lot in your work about benchmarking and how it's very unfair how certain strategies get judged over very short time horizons. And one of the sort of interesting conclusions from running the analysis on all this work is that the vast majority of our portfolios are actually, they're much longer term than most people think. An all stock portfolio is always going to end up being a much longer term portfolio than we judge on a Morningstar rating scale, 3, 5, even 10 years. And, this is even more so true of a portfolio like a 60/40, where that thing ends up looking like a 10 to 12 year instrument. And so from a benchmarking perspective, though, it provides a lot of perspective because it provides you with reasonable time horizons over which to judge different types of portfolios.
You guys have 3 ETFs. So if you go to disciplinefunds.com, you can find 3 defined duration. You got DDV, DDX, DDXX. And, they kind of space out over what's 5-year, 10-year, and then 20-year. Give us a little overview. I'm guessing most investors probably, if they had to guess without looking, would probably guess the shorter one's going to have more bonds, the longer term's going to have more equities. Talk to us a little bit about these strategies. They're wicked cheap, by the way. I don't know how you keep the lights on over there, Cullen, but tell us a little bit about these strategies.
They were fun to create because they're what I call time-weighted strategies. So this whole underlying methodology it's designed to match to a time horizon. So using this defined duration methodology, for instance, the 5-year instrument is designed to be able to generate stable 5-year real returns over rolling 5-year period. And so it's almost like a constant maturity bond fund, except that I would argue that this sort of an instrument, it's going to look a lot like a bond ag over the course of a rolling 5-year period, but it's very likely to, at least in our estimation, generate a similar return profile that hopefully generates a little higher return, in large part because what the instrument is doing is it has removed all of those long duration bonds inside of it. And so it's actually like a barbell strategy where we've taken the 15% slice of the equity market and we're buying basically high quality stocks inside of a 15% slice. And again, we're buying what I would call shorter defined duration equities and then blending them with very short duration notes and bills, basically. And that blends into a 5-year instrument inside of this methodology where it looks a lot actually like a bond ag in terms of its actual time horizon over which it's designed to generate performance. But we think that it will generate higher returns than a bond ag because it doesn't have the drag of all the long duration bonds. And that's one of the interesting things about a bond ag is that it has a relatively long duration, and the duration has gotten longer and longer in large part because the US government just keeps issuing longer and longer bonds into the market, where even though interest rates are lower, they're issuing duration into the market increasingly, and this is very likely to continue. And so I think that rebalancing away from those longer duration instruments makes a lot of sense because you're functionally replacing what I view as a good long duration instrument in stocks with a very bad long duration instrument in long duration bonds inside of an instrument like that, while retaining the shorter return profile on average, because what you're doing is basically you're barbelling the thing so heavily with the bills and notes that you're creating something that's actually very stable and has a similar sort of risk profile to a bond ag. And so each fund is sort of segmented like that.
One of the biggest surprises in my career in the past 10 years has been, look, I think these are awesome solutions. I wrote about this a decade ago. I wrote about it recently in a post called Not Disrupted Yet. And we said, look, there's almost $1 trillion in tax inefficient mutual funds that charge over 0.5%, many of which charge 1.5%, 2%. And there's about only, quote, only 20 billion in asset allocation ETFs that charge less than 50 basis points. And excluding the ones that we manage, there's about 20. Cullen now is 3. And this is crazy to me because you've seen so much disruption in our world of ETFs eating the asset management industry. And yet, in the one area where people sock away the money for decades, often they're in these terrible, expensive, and granted, a fair amount are in tax deferred, but even if they are, they're still over 50 basis points versus the ones, the ETF. And so I listed one of yours. And so, looking forward the next 10 years, I think this will be a sea change of hundreds of billions of dollars. One can hope.
Yeah, it'll be interesting to see, because when you work with, after the financial crisis, I worked with a lot of banks on asset liability matching strategies and stuff like that. And this is a concept that it's so institutionalized. It's utilized by a lot of pension funds and, a lot of banks, obviously. And it's not popular with the financial planning community and the retail investment space, in large part because there aren't good solutions for it. There aren't good time-based solutions for these things. And we've sort of seen that target date funds have become a thing in the last 20 years. And target date funds, I wrote an entire chapter on target date funds actually in the book. And target date funds are good, but target date funds they're kind of clunky in a lot of ways because of the way they operate. And this sort of a strategy, I hope over time, gives people the ability to build a sort of target date fund, but it can be extremely customizable, where it's matching to look like a target date fund, but it can evolve in a way that the actual investor needs it to evolve by changing the way the different pieces interplay. And so it'll be interesting to see. I've said this a lot in my work recently, that I think asset liability matching and this sort of liability-driven investing strategies will become the way that all financial planning, or most financial planning, is done over the course of the next 20 years. Maybe I'm wrong, but to me, it makes so much sense to, especially if you're a financial planner who's working on helping people understand how their assets match to certain time horizons and consumption needs. The assets should serve that. And target date funds do that. There's a lot of sort of bond-like instruments that do something like that, but there's not good solutions especially not in the multi-asset space and not in the equity-only space. And I hope that this sort of time-weighted structure becomes something that can complement even market cap weighted structures and the way that people build portfolios, so that you develop a little bit better understanding of how the assets are serving very specific needs across specific time horizons in your portfolio.
I think it's 3 things. I think it's a bear market will cause people to exit these funds and they won't go back. Like, no one has a fund that charges 1.5, market goes down 50 and they exit and they go back and buy it again. Almost never. But 2 is death and divorce, right? The 3 Ds: death, divorce, drawdown. And, I think one of the reasons this has been so sticky is because the inefficient structure and the fees have been masked by the performance of US stocks for the past 15 years. So if your money is in your account and you look down and it's doing 15% a year, you're like, oh, I don't need to move this. It doesn't matter if I'm paying 2% on this fund, because I'm still seeing it go up, and it's a big number. But once you see one of those other three things happen, it comes to light, right? You see, perhaps it in front of your face. We'll see. As I said before in my article, maybe I'm just sour grapes because we've been doing this for a decade and haven't seen it happen yet. So one of these days. Cullen, what's the best place to keep up with what you're doing these days?
Discipline Funds. I write a sort of bloggy discipline alerts there. If people want to subscribe to it, you can get, some macroeconomic commentary, some random, weekend reading and stuff like that. So try to stay on top of current events.
Cullen, it's been a blast hanging out with you again. Thanks so much for joining us today.
Awesome, Meb. Thanks for having me, man.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.